Welcome to this CA Final IDT Revision session on types of customs duty. In this video, we'll systematically understand the statutory framework governing customs duties in India, including basic customs duty, IGST, GST compensation cess, valuation provisions, warehoused goods, additional duties, emergency powers, and safeguard measures. Rather than memorizing isolated provisions, we'll connect the logic behind each levy so that concepts become easier to understand, retain, and reproduce in examinations. Every customs duty begins with one foundation provision, Section 12 of the Customs Act. This is the charging section, which authorizes levy of customs duty on goods imported into or exported from India. However, Section 12 only creates the charge. The actual rates are obtained from the Customs Tariff Act, 1975. Think of Section 12 as the engine and the Tariff Act as the fuel determining how much duty will ultimately be charged. Together, they form the backbone of customs taxation in India. Basic customs duty, commonly called BCD, is levied under Section 12 of the Customs Act read with Section 2 of the Customs Tariff Act. The Customs Tariff Act contains two important schedules. The first schedule specifies import duty rates, while the second schedule specifies export duty rates. Whenever goods enter India, the applicable BCD rate is identified from the first schedule. Therefore, understanding these schedules is essential because they determine the actual duty burden on imported and exported goods. India follows the Harmonized System of Nomenclature, or HSN, for classifying goods. While the international HSN structure operates at a 6-digit level, India uses a more detailed 8-digit classification in the first schedule. Each entry contains the HSN code, description of goods, unit of measurement, standard BCD rate, and preferential BCD rate. This detailed classification ensures accurate identification of goods and correct determination of customs duty liability during importation. Normally, imported goods attract the standard rate of basic customs duty. However, a lower preferential rate may be available under trade agreements. To claim this benefit, 4 conditions must be satisfied. The importer must make a specific claim, the goods must originate from the notified preferential area, the area must be officially notified, and the origin must be established according to prescribed rules. Missing even one condition means the importer loses the benefit and must pay the standard customs duty rate. Export duties are governed by the second schedule of the Customs Tariff Act. India's foreign trade policy follows a simple philosophy: goods should be exported, not taxes. Therefore, export duty is generally not imposed on most products. However, the government may levy export duty on selected goods whenever policy considerations require it. Such duties are often used to protect domestic availability of essential commodities or regulate exports in the national interest. Apart from basic customs duty, imported goods are also liable to integrated GST under Section 3(7) of the Customs Tariff Act. The maximum statutory rate can be 40%. Though the commonly applicable rate is generally 18%. An important point is that IGST is calculated after considering customs duties and even applies on the social welfare surcharge component. The good news for registered importers is that the IGST and compensation cess paid on imports can generally be claimed as input tax credit under GST. Certain imports receive special treatment under customs law. Goods imported by SE's units or developers for authorized operations are fully exempt from IGST under the relevant notification. Similarly, 100% export-oriented units can import specified goods duty-free under Notification 52 of 2003, subject to prescribed conditions. These incentives are designed to promote exports, enhance competitiveness, and support industries that contribute significantly to foreign exchange earnings and economic growth. GST compensation cess is levied under Section 3(9) of the Customs Tariff Act and derives its authority from the Compensation to States Act 2017. Its primary objective is to compensate states for revenue losses arising from GST implementation. This cess generally applies to luxury and sin goods, such as tobacco products and pan masala. It is charged in addition to other applicable taxes and duties. Imports by SEZ units and developers for authorized operations continue to enjoy exemption from this levy. To calculate IGST and compensation cess, we first determine a special assessable value under Section 3(8). This value consists of the customs value determined under Section 14 plus customs duties and any additional sums chargeable under law. However, there is an important exclusion. While calculating this assessable value, IGST itself and compensation cess itself are not included. Remember this carefully because valuation errors are among the most common mistakes in customs examination questions. The computation process is straightforward if followed step by step. First, determine the value of imported goods under Section 14. Second, add basic customs duty and other applicable customs levies. This gives the assessable value for IGST and compensation cess. Finally, apply the relevant IGST rate and cess rate on this common assessable value. A key examination point is that IGST and compensation cess are computed on the same base value and not one after another. Special valuation provisions apply when warehoused goods are sold before clearance. If the entire quantity is sold, the value for IGST purposes will be the higher of the assessable value under Section 3.8, or the transaction value. The same higher of principle applies even when only part of the goods is sold. This provision prevents undervaluation and ensures that customs authorities can levy tax on the most appropriate value available. A practical complication arises when warehoused goods are sold multiple times before clearance. In such cases, customs law adopts a simple rule. The transaction value of the last sale is considered for valuation purposes. This prevents disputes regarding earlier transactions and reflects the final commercial value of the goods. For unsold goods, valuation continues to be determined according to the normal provisions under Section 3.8. Compensation cess follows exactly the same valuation mechanism. Additional duty under Section 3.1 aims to create parity between imported goods and domestically manufactured goods. The duty is generally equal to the excise duty applicable on a similar article produced in India. After GST, excise duty survives mainly for petroleum products and tobacco products, so the practical relevance of this levy is now largely confined to these sectors. Imported alcoholic liquor follows a special rule where rates are notified considering state excise duties applicable within India. Countervailing duty, or CVD under Section 3.3, is imposed to offset excise duties borne by raw materials, components, and ingredients used by domestic manufacturers. The objective is to create a level playing field between imported and domestic products. Special additional duty, or SAD under Section 3.5, serves a similar purpose by neutralizing VAT, sales tax, local taxes, and related levies applicable in India. The maximum rate of SAD cannot exceed 4% of the imported article's value. The government possesses emergency powers to quickly modify customs duties when circumstances demand immediate action. Under Section 8, export duties may be imposed or increased by amending the second schedule. Under Section 8A, import duties may be enhanced through amendments to the first schedule. These powers help the government respond rapidly to economic disruptions, shortages, or market imbalances. However, parliamentary oversight exists, ensuring that such powers are exercised responsibly and within statutory limits. Safeguard measures under Section 8B protect domestic industries from sudden surges in imports. Before imposing such measures, the government conducts an inquiry to determine whether increased imports are causing or threatening serious injury to domestic producers. If satisfied, it may impose safeguard duty, tariff rate quotas, or other suitable protective measures. The objective is not to permanently restrict trade, but to provide domestic industries sufficient time to adjust and become competitive against import pressure. Safeguard measures are temporary in nature. The initial period can extend up to 4 years, and with justified extensions, the total duration cannot exceed 10 years. Developing countries receive special protection from these measures. If imports from a particular developing country do not exceed 3% of total imports, exemption is available. Similarly, where multiple developing countries are involved, their combined share must not exceed 9%. These thresholds reflect India's commitment to fair international trade practices. Let's quickly recap. Section 12 is the foundation of customs duty levy. Basic customs duty arises from the Customs Tariff Act schedules. Imported goods generally attract IGST and, where applicable, compensation cess. Valuation provisions under Sections 3.8 and 3.8a are critical for examination purposes. Emergency powers under Sections 8 and 8a enable quick tariff changes, while safeguard measures under Section 8b protect domestic industries from harmful import surges. Mastering these provisions gives you a strong conceptual grip on the entire customs duty framework. In this part, we move into some of the most important protective duties under the Customs Tariff Act. We'll cover safeguard measures, countervailing duty, and anti-dumping duty. These duties are designed to protect Indian industries from unfair competition, sudden import surges, and foreign government subsidies. Along the way, we'll also understand important concepts such as provisional duties, retrospective levies, the lesser duty rule, and key statutory timelines that are frequently tested in CA final examinations. By the end of this session, you'll have a complete conceptual and exam-oriented understanding of these protective customs measures. Before diving into the details, let's understand the roadmap of this chapter. First, we'll complete the remaining provisions relating to safeguard measures under Section 8B. Next, we'll study countervailing duty under Section 9, which neutralizes subsidies granted by foreign governments. Finally, we'll cover anti-dumping duty under Section 9A, including the concepts of dumping, normal value, export price, injury margin, and the lesser duty rule. These provisions collectively ensure fair trade while protecting domestic industries from economic injury. As a general rule, safeguard measures do not apply to imports made by 100% export-oriented units and units operating in special economic zones. The objective is to promote exports and maintain competitiveness by keeping imported inputs free from additional duty burdens. However, there are important exceptions. Safeguard duty may apply if a notification specifically extends it to such units, or if the imported goods are cleared into the domestic tariff area. Similarly, if imported goods are used in manufacturing products that are later cleared into the DTA, safeguard duty becomes applicable on the relevant portion cleared into India. Sometimes, immediate action is required before a detailed investigation is completed. In such cases, the central government can impose a provisional safeguard measure based on a preliminary finding that increased imports have caused or threatened serious injury to domestic industry. However, this provisional protection is temporary and cannot remain in force for more than 200 days from the date of imposition. If the final investigation concludes that no serious injury exists, the entire provisional safeguard duty collected during this period must be refunded to importers. Safeguard measures are not left solely to executive discretion. Every notification issued under Section 8B must be placed before both Houses of Parliament while they are in session. The notification must remain before Parliament for a total of 30 days, either in one session or across multiple sessions. During this period, Parliament may modify or even annul the notification. However, any actions already taken under the notification before such modification or annulment remain legally valid and unaffected. Countervailing duty, commonly called CVD, is imposed to neutralize unfair advantages arising from foreign government subsidies. Under Section 9, if a foreign country directly or indirectly grants subsidies for the manufacture, production, transportation, or export of goods, and those goods are imported into India, countervailing duty may be imposed. Importantly, the goods may arrive in the same condition as exported or after further processing. The purpose is simple: to ensure imported subsidized goods do not unfairly harm Indian producers. For countervailing duty to apply, a subsidy must legally exist. A subsidy is deemed to exist when a government or public body provides financial contributions such as grants, loans, guarantees, or revenue waivers. It may also exist where income or price support artificially boosts exports or reduces imports. Even indirect government intervention counts. For example, if a private body performs governmental functions under government direction or funding, the benefit provided may still be treated as a subsidy for countervailing duty purposes. Countervailing duty is subject to strict limits. The duty imposed cannot exceed the amount of subsidy actually granted. It is also an additional levy, meaning it applies over and above other customs duties. However, not every subsidy attracts CVD. The subsidy must relate to export performance, encourage the use of domestic goods over imported goods, or benefit only specific industries, enterprises, or groups. These conditions ensure that only distortive subsidies become subject to countervailing action. Countervailing duty is generally imposed for 5 years from the date of its introduction. However, if a review indicates that removing the duty would likely result in continued subsidization and injury to domestic industry, the central government may extend it for another period of up to 5 years. If a review is still pending when the original 5-year period expires, the duty can continue for a maximum additional period of 1 year. Temporary revocation is also possible, but such revocation cannot exceed 1 year at a time. Foreign exporters sometimes attempt to avoid countervailing duty through clever methods. This is known as circumvention. Examples include changing product descriptions, altering composition, importing goods in unassembled form, or routing goods through another country. To prevent such practices, the central government can extend the duty to these altered products. Another issue is absorption, where exporters reduce their prices to absorb the impact of duty and keep market prices unchanged. In such situations, the government may modify the duty to restore its effectiveness. While investigations are ongoing, provisional countervailing duty may be imposed based on estimated subsidy amounts. If the final determination reveals a lower subsidy, any excess duty collected must be refunded. In exceptional cases, CVD can also be imposed retrospectively. This happens when massive imports within a short period cause serious injury that is difficult to repair. However, retrospective application cannot go back beyond 90 days from the date of notification, ensuring a clear statutory limit on such action. Anti-dumping duty addresses a different problem. Dumping occurs when a product is exported to India at a price lower than its normal value in the exporting country's domestic market. Dumping itself is not automatically illegal. Action is taken only when it causes or threatens material injury to Indian industry. Another important point is that anti-dumping duty is country-specific. It applies only where an Indian industry produces similar goods and can demonstrate injury resulting from dumped imports. India follows the internationally recognized lesser duty rule. Under this principle, anti-dumping duty is not imposed at the highest possible level. Instead, the duty is restricted to the lower of two figures, the margin of dumping or the injury margin. This approach ensures that the duty remains remedial rather than punitive. The objective is not to punish foreign exporters, but simply to remove the injury suffered by domestic industry and restore fair competition in the market. The margin of dumping is the foundation of anti-dumping duty calculations. It represents the difference between the normal value and the export price. Sometimes the export price is unavailable or unreliable because of relationships between exporters and importers. In such cases, a constructed export price is determined based on the first resale to an independent buyer. This adjusted figure helps authorities calculate the true extent of dumping and determine whether corrective action is necessary. Normal value generally refers to the price of a like product sold in the ordinary course of trade within the exporting country. However, if no such domestic sales exist, alternative methods are used. Authorities may consider the price charged in an appropriate third country, or calculate normal value using production cost, plus reasonable additions for administrative expenses and profit. In cases involving transshipment or indirect exports, normal value is usually determined with reference to the country of origin, rather than the exporting country. The injury margin measures the extent of injury suffered by domestic industry. It is calculated as the difference between the fair selling price, also called the non-injurious price, and the landed value of imported goods. The non-injurious price reflects a reasonable price that covers costs and profits under normal business conditions. Landed value includes assessable value plus applicable basic customs duties. According to judicial precedent, only one non-injurious price can exist for a particular product, ensuring consistency in calculations. Just as with countervailing duty, anti-dumping duty can also be circumvented. Exporters may alter product descriptions, modify composition, import products in unassembled form, or change the declared country of origin. The government can extend anti-dumping duty to such products from the initiation date of the inquiry. Absorption occurs when exporters reduce export prices to offset the impact of duty. If such practices are detected, authorities may revise the duty to ensure the intended protection for domestic industry remains effective. Under exceptional circumstances, anti-dumping duty can be imposed retrospectively. This is permitted when there is a history of dumping causing injury, or where importers knew or should have known about the dumping and its harmful effects. It is also allowed when massive dumping over a short period threatens to undermine the remedial effect of the duty. Even in such cases, retrospective application cannot extend beyond 90 days from the relevant notification date. While investigations are pending, the central government may impose provisional anti-dumping duty based on estimated figures. If the final duty determined is lower, excess collections must be refunded. Additionally, importers who prove they paid duty beyond the actual margin of dumping are entitled to refunds. Similar to safeguard and countervailing duties, anti-dumping duty generally does not apply to imports made by 100% EOUs and SEZ units, unless specifically notified, or when goods are eventually cleared into the domestic tariff area. Anti-dumping duty normally remains in force for 5 years. Following a review, it may be extended for another 5 years if the likelihood of continued dumping and injury remains. Where a review is pending at expiry, the duty can continue for up to 1 additional year. Every anti-dumping notification must also be laid before Parliament. Furthermore, If exporters fail to provide necessary records during investigations, authorities are empowered to determine dumping margins using the best facts available. For examination purposes, determining the commencement date of anti-dumping duty is extremely important. If no provisional duty exists, the definitive duty starts from the date of the final notification. If provisional duty has already been imposed, the commencement date shifts to the provisional duty notification date. In cases of retrospective levy, the notified retrospective date becomes relevant, subject to the statutory restriction that it cannot extend beyond 90 days before the provisional duty notification. This is a favorite area for practical questions in CA final exams. In this final part of customs duties, we focus on some highly examinable provisions that often appear in both theory and practical questions. We will study restrictions on the levy of countervailing duty and anti-dumping duty under Section 9B, appellate provisions under Section 9C, social welfare surcharge, agriculture infrastructure and development Cess, and finally, the important amendments introduced by the Finance Act 2023. These topics may appear technical at first, but once understood logically, they become easy scoring areas in the CA final examination. Section 9B acts as a safeguard against unfair or excessive taxation. While countervailing duty and anti-dumping duty are intended to protect domestic industries, they cannot be imposed without limits. This section specifies situations where these special duties are restricted or prohibited. The objective is to ensure compliance with international trade principles while still providing legitimate protection to Indian industries. Think of Section 9B as a control mechanism that prevents misuse of protective customs duties. One of the most important restrictions under Section 9B is the principle against double jeopardy. An imported article cannot be subjected to both countervailing duty and anti-dumping duty for the same instance of dumping or export subsidization. Another restriction relates to exemptions or refunds granted in the exporting country. Merely because a product enjoys tax exemption or tax refund in its home country does not automatically justify the levy of CVD or ADD in India. These duties must be based on genuine injury and statutory requirements, not simply on foreign tax policies. Generally, countervailing duty and anti-dumping duty cannot be imposed on imports originating from WTO member countries or nations enjoying most favored nation status with India. However, there is a significant exception. If imports cause or threaten material injury to an established Indian industry or delay the establishment of such industry, these duties may still be imposed. Similarly, provisional duties require preliminary findings of dumping or subsidy and proof that immediate protection is necessary. An additional exception exists where duties are imposed to prevent injury to a third country exporting similar goods to India. Whenever disputes arise regarding safeguard duty, countervailing duty, or anti-dumping duty, the appellate forum is the Customs, Excise, and Service Tax Appellate Tribunal, commonly known as CESTAT. Appeals can be filed against determinations or reviews involving subsidies, dumping, or increased imports causing serious injury. In simple terms, if any party disagrees with the findings regarding special customs duties, CESTAT acts as the judicial authority responsible for reviewing and deciding such disputes. The law prescribes a strict timeline for filing appeals before CESTAT. Every appeal must generally be filed within 90 days from the relevant order, determination, or review. However, if sufficient cause is shown, the tribunal has the power to condone the delay. Regarding fees, a main appeal requires payment of 15,000 rupees, while applications such as stay requests, rectification of mistakes, or restoration of appeals attract a fee of 500 rupees. After hearing both sides, CESTAT may confirm, modify, or annul the disputed decision. Social welfare surcharge, commonly called SWS, is an additional levy imposed on imported goods. It is charged at the rate of 10% and was introduced in place of earlier education-related cesses. The funds collected are intended to support education, healthcare, and social security initiatives. For examination purposes, remember the most important point. SWS is effectively calculated at 10% of the basic customs duty collected on imported goods. This simple shortcut helps solve most practical questions quickly. While computing the base for social welfare surcharge, certain duties must be excluded. These include safeguard measures under Section 8B, countervailing duty under Section 9, anti-dumping duty under Section 9A, and the surcharge itself. Additionally, integrated GST and GST compensation cess are also excluded, as per the relevant notification. This area is frequently tested in customs duty computations, so remembering these exclusions can help avoid unnecessary calculation errors during the examination. Agriculture, Infrastructure and Development Cess, or AIDC, is another additional levy imposed on specified imported goods. Its objective is to generate funds for improving agricultural infrastructure and supporting development expenditure. This cess applies to notified goods, such as certain agricultural products, precious metals, and other specified imports. Importantly, AIDC is levied in addition to all other customs duties and follows the administrative provisions of the Customs Act regarding assessment, refunds, appeals, and penalties. The Finance Act 2023 introduced several amendments relating to customs law. However, a crucial examination point is that these amendments become effective only from a date specifically notified by the central government. Since no such notification had been issued up to the 30th of April 2025, students are expected to follow ICAI announcements regarding applicability for future examinations. Therefore, always verify the latest ICAI guidance before applying these amendments in examination answers. Although the general applicability depends on notification, the amendments relating to Sections 9, 9A, and 9C have been given retrospective effect from the 1st of January 1995. The main objective behind these amendments is clarification, rather than substantive change. The legislature intended to remove redundant terminology and clearly establish that determination and review of special duties must be conducted strictly according to prescribed rules. This improves legal certainty and procedural consistency. In Section 9, dealing with countervailing duty, the language relating to reviews has been refined. Earlier, the law referred to situations where the central government, in a review, formed an opinion. This has now been replaced with the phrase "on consideration of a review." Another significant change is the removal of the words "and determined" from provisions dealing with subsidy calculation. The amendment emphasizes the process of ascertainment while eliminating redundant wording. The amendments to Section 9A closely mirror those made in Section 9. References to the government acting in a review have been replaced with "on consideration of a review." Similarly, while discussing the margin of dumping, the words "and determined" have been omitted. These changes do not significantly alter the substance of the law, but improve drafting precision and align the provisions with the legislative intent behind the Finance Act 2023 amendments. Section 9C witnessed important terminology changes. Earlier, appeals were filed against an order of determination or review. The amended law simplifies this by referring directly to the, quote, determination or review. Similarly, time limits are now linked to the determination or review itself, rather than the order. The tribunal's powers have also been aligned with this terminology. Additionally, a new explanation clarifies that determination and review must be carried out strictly according to the rules framed under Sections 8B, 9, 9A, and 9B. Let's quickly recap the most important points. Section 9B prevents double jeopardy and imposes restrictions on CVD and ADD. Appeals relating to special duties lie before CESTAT within 90 days, with a fee of 15,000 rupees. Social welfare surcharge is generally 10% of basic customs duty and excludes several specified levies from its base. AIDC is imposed on notified goods to support agricultural development. Finally, Finance Act 2023 amendments mainly focus on refining terminology and clarifying the concept of determination and review, with retrospective effect from the 1st of January 1995. These are high-value revision points for the examination